Do you worry that one bad market crash could permanently ruin your retirement no matter how much money you save? Well, in this video, I'm going to show you the one mental framework that can stop retirees from worrying about investing, what the biggest threats to retirement portfolios actually are, and how to help protect yourself before the next crash arrives. Let me show you the one question that will completely change the way you think about protecting your retirement. During World War II, an American soldier named Charlie was assigned the job of predicting the weather in Alaska. But he quickly realized his real job wasn't predicting the weather. It was clearing pilots for takeoff. So, understanding that one wrong call could cost someone their life, Charlie started thinking in a very different way. Instead of asking, "How do I keep pilots safe?" he flipped the question. He asked, "If I wanted to kill as many pilots as possible, what would I do?" Instead of asking how to succeed, he asked himself what it would take to fail. This type of thinking is called inversion. And decades later, Charlie Munger used this same mental model to become one of the greatest investors of all time. And you can apply his thinking directly to how you invest. So ask yourself the same question Charlie did. If I wanted to guarantee I'd run out of money in retirement, how would I invest? When I asked myself that question, I found 5 mistakes that might be putting your retirement at risk. And the first mistake is one almost every retiree worries about, but very few realize how simple it is to protect against. Let's say you retired in 2003 with $1 million portfolio. Even after using the portfolio to pay for retirement every year, you'd still end up with more than $2 million 20 years later. But now, let's look at the same situation, but with one change. In the first scenario, you started with a 29% return and ended with an 18% loss. So now, let's flip those. The bad year happens first and the good year at the end. Even though everything else is exactly the same, instead of finishing with over $2 million, you'd be completely out of money by year 17. Think of your portfolio like a bucket of water. If you're scooping water out the top and there's a hole at the bottom, it empties twice as fast. But protecting against this is much simpler than you think. So let me show you the impact of making just one small change to your strategy. Instead of selling at a loss to pay your bills, you temporarily live off a cash reserve instead. You wait 2 years before taking withdrawals from your portfolio again. And when you do this, instead of being completely out of money by year 17, you'd finish the period with the same $1 million you started with. Having a cash buffer is like patching the hole at the bottom of the bucket. It stops the bleeding long enough for your investments to recover. So if I wanted to guarantee I'd run out of money, I'd make sure I had no choice but to sell at a loss every time the market dropped. Just by having a small cash buffer heading into retirement, you're more protected than you might think. But a cash buffer only protects you if your portfolio actually recovers. And the second mistake makes that a lot less likely. And it's the one almost everyone is tempted to make after the last few years. In each of the last 3 years, just 7 stocks drove more than half of the entire S&P 500's return. And this isn't new. Over the last century, just 50 companies created nearly half the wealth generated by the entire US stock market. So if you pick just a few of the right stocks, you'd be set. But here's what the data shows when you try to do that. JP Morgan looked at the Russell 3000 index, which is essentially the entire US stock market from 1980 through 2020. And they found that 40% of all companies ever in the index experienced a catastrophic price loss, a 70% drop they never recovered from. Even in tech, the best performing sector of the last several decades, the index still beat nearly 3 out of every 4 individual stocks. The problem with trying to hit home runs is that you're going to strike out a lot. And in retirement, you can't afford to strike out. So instead of trying to pick the winners, it's much safer to own the whole index. That way, you automatically capture the ones that do win without putting your retirement at risk if your picks don't turn out. And after seeing this, a lot of retirees do the sensible thing. Instead of picking individual stocks, they may put that money into the index that's been performing the best. But that instinct leads to the third mistake, and it's one that's completely understandable after watching the US dominate for so long. Over the last 15 years, the US has more than doubled the returns of the rest of the world. Today, it's worth more than the next 9 largest stock markets combined. And with America's biggest companies continuing to dominate the headlines, it feels like the obvious place to invest. But the thing is, we've seen this movie before. In the late 1980s, Japan looked unstoppable. For 3 decades, Japan's stock market had left the US in the dust, earning over 10 times the return. The Japan market had grown so much that it now made up almost half of the world's stock market. At the time, almost nobody believed their dominance would end. Just look at these Time magazine covers, calling Japan the world's toughest business competitor and how the Japan business invasion was inbound. But then, just a few months later, the Japanese market began its crash. It fell nearly 60% over the next few years, and investors waited more than 30 years just to break even. Our brains are wired to believe today's winner will still be tomorrow's winner, but that isn't always the case. So the third mistake that can make you run out of money would be assuming that what's dominated recently will keep dominating. For retirees today, that means putting everything in the US and almost nothing everywhere else. When you buy a global index instead, you don't have to guess which country will lead the next 20 years. And doing this is what protects you against having to wait decades for a recovery that may never come. And this leads right into the fourth mistake, because after seeing even the strongest markets crash, it makes complete sense to want to move your money into cash. See, a market crash feels like someone breaking into your house. You can see and feel the damage, and you know exactly what's gone. But inflation is more like a slow leak in your roof. By the time you notice the damage, it's already done. Over the last 20 years, the average annual inflation rate has been 2.5%. And at that rate, $100,000 in cash will be worth about $61,000 20 years later. But from 1965 to 1984, inflation averaged almost 6.5%. And that means the same $100,000 would see its purchasing power plummet to less than $29,000 in just 20 years. But here's what makes that damage even more dangerous than most retirees realize. Historically, every 20-year period in market history has produced positive returns. So no matter how much damage a crash caused, eventually you'd have recovered your losses. But if you retire at 60 and find yourself at 80 with your money only covering a fraction of your expenses, what options do you have? There's no reasonable way to turn $29,000 back into $100,000 in a short time. History shows markets always recover, but inflation doesn't work that way. Once that purchasing power is gone, it's gone. So the fourth investing mistake is to put everything into cash and ignore inflation. Just by keeping a portion of your portfolio invested in the stock market, you protect yourself from the one kind of damage you can't undo. But keeping your money invested is much easier said than done when the market drops 30% and every headline says the world is ending. And that's where the fifth mistake comes in, and it happens far more often than anyone admits. In 1977, legendary investor Peter Lynch took over a tiny fund with Fidelity. Over the next 13 years, it averaged 29% per year, one of the best runs in investing history. So with returns like that, you'd expect investors to have made a fortune. But the average investor in the fund actually ended up with less than they put in. When the fund had a big year, like nearly 70% in 1980, people poured in money. But when it dropped, they panicked and pulled it out. And most people assume that they'd be different. But Dalbar has spent decades comparing returns of the average investor to the various places they could have invested. And their research shows the average investor consistently underperforms almost every investment category. Most retirees spend hours trying to pick the best investments without asking whether they'd actually stay in them when things go south. So the fifth way you can run out of money is investing in something you can't stick with when things get hard. You need to know if you can stick with your investments before the market drops, not after. Because as Nobel Prize winning economist Eugene Fama puts it, money is like soap. The more you handle it, the less you'll have. So once you see you're already protected from a lot of the mistakes that can make you run out of money, it can help you stop worrying about investing. But as soon as retirees tackle this fear, it leads to an even bigger one. They're terrified of spending their money, and it keeps them living like they're still saving even when they don't need to. So watch this video next to see the data that can help you stop worrying about spending.